In the early 1600s, the Netherlands was not yet the quiet, orderly country many imagine today. It was a young republic at war, surrounded by empires, and fighting for survival against Spain. Its land was small. Its population was modest. Its cities were crowded, damp, and vulnerable to the sea. But inside those cities, something extraordinary was happening. Merchants, shipbuilders, bankers, mapmakers, politicians, and powerful families were inventing a new way to organize money, risk, and ambition. That invention became the Dutch East India Company, known by its Dutch initials, the VOC. It was not just a trading company. It was a machine for turning private wealth into global power. It could build fleets, make treaties, wage war, seize ports, mint coins, and govern distant territories. And in 1602, when it sold shares to the public in Amsterdam, it created what is widely remembered as the world's first modern initial public offering. But the VOC did not appear from nowhere. Behind it was a network of family power, dynasties of merchants, regents, financiers, and ship owners who understood that the future belonged to those who could combine capital at a scale no single household could manage alone. To understand the world's first IPO, we have to begin with a problem: spices. In the 1500s, pepper, cloves, nutmeg, and mace were more than flavor. They were medicine, preservative, luxury, and status. A tiny island in Southeast Asia could produce something worth a fortune in Europe. For decades, Portugal controlled much of the route around Africa to the Indian Ocean, while Spanish power dominated European politics. Dutch merchants wanted access, but a voyage to Asia was costly, dangerous, and slow. A ship might be lost to storms. A crew might die of disease. Cargo might be captured. A successful voyage could make investors rich. A failed one could ruin them. At first, Dutch merchants used the old model. They formed small private companies for individual expeditions. Investors pooled money, sent ships east, and hoped the cargo returned. These ventures were built on personal trust. Brothers, cousins, in-laws, and longtime partners backed one another. Family names mattered because reputation was security. If a merchant promised to invest, insure, supply, or manage, people needed to believe his household stood behind the promise. In Amsterdam, Zeeland, Rotterdam, Delft, Hoorn, and Enkhuizen, these family-based networks grew fast. Some families owned ships. Others controlled warehouses, credit, or political offices. Many controlled all three. In the Dutch Republic, the line between business and government was thin. The men who governed cities often financed trade. Their sons married into trading families. Their daughters carried alliances through dowries. A marriage could join capital, ships, votes, and access. This was the Dutch dynasty behind the VOC. Not one royal family, but an interlocking class of merchant regent families whose power came from money, office, and trust. By the late 1590s, Dutch expeditions to Asia were increasing. Profits could be spectacular, but competition created a new problem. Companies from different Dutch cities raced to buy the same spices, hire the same sailors, and negotiate with the same Asian rulers. Instead of weakening Portugal and Spain, they sometimes weakened each other. Prices rose in Asia, profits became unstable. The young republic needed something bigger than scattered voyages. The solution was consolidation. In 1602, under pressure from the States General, separate Dutch ventures were merged into one giant company, the Verenigde Oost-Indische Compagnie, the United East India Company. The VOC received a monopoly on Dutch trade east of the Cape of Good Hope and west of the Strait of Magellan. In practice, if Dutch merchants wanted to trade with Asia, they had to do it through the VOC. This was a revolutionary bargain. The state gave the company exclusive rights and semi-sovereign powers. In return, the company served the Republic's strategic interests. It would challenge Iberian power overseas, bring valuable goods into Dutch ports, and strengthen the economy funding the war for independence. But this company required more money than traditional ventures. It needed permanent capital, money that would not vanish after one voyage. Ships had to be built before cargo existed. Forts had to be maintained. Factors, sailors, soldiers, clerks, and governors had to be paid across continents. The VOC needed investors who could wait. So the company invited people to buy shares. This was the great leap. Instead of financing one voyage, investors bought into a continuing enterprise. Their money entered a long-term pool of capital. They could receive dividends if the company succeeded. And because shares could eventually be traded, investors were not completely trapped. If they needed cash or lost confidence, they could sell their stake. In Amsterdam, Subscription books recorded investors from different layers of society. Wealthy merchants invested large sums. Skilled workers, widows, shopkeepers, and smaller savers could participate too, though power remained concentrated among major shareholders and directors. The idea was simple but world-changing. Many people could own pieces of one company, and those pieces could move from hand to hand. The world's first IPO was not a polished, modern event with stock tickers and financial television. It was ink, ledgers, signatures, trust, and reputation. It was a social network becoming a financial network. It was family wealth turning into corporate capital. At the top of the VOC stood the directors, the Heren 17, the 17 gentlemen. They represented regional chambers, with Amsterdam holding the greatest influence because it contributed the largest share of capital. These men were not anonymous executives. They belonged to powerful urban families. They knew one another through councils, churches, marriages, and trade. Their authority came from the company charter and from their place inside the Dutch ruling class. Family power shaped the VOC in three ways. First, it supplied trust. In a world without instant communication, trust was everything. A ship leaving for Asia might not return for 2 years. Letters took months. News could be false, late, or incomplete. Investors had to trust directors. Directors had to trust captains and agents overseas. Families with long commercial reputations became anchors of credibility. Second, family power supplied capital. Wealth accumulated across generations could be mobilized quickly. A successful merchant father could place sons in trade, marry daughters into allied houses, and spread risk across shipping, finance, real estate, and public debt. When the VOC required large subscriptions, these networks could answer. Third, family power supplied political influence. The Dutch Republic was governed through cities and provinces, not by an absolute king. Urban elites held real power. If a merchant family had seats in city government, it could shape policy, negotiate privileges, and defend the company's interests. The VOC was private enterprise fused with public authority, and family networks were the stitching. Yet the VOC was not merely a triumph of finance. It was also a violent imperial force. Its rise depended on coercion as well as contracts. In Asia, the company used armed ships and soldiers to secure monopolies. It built forts, displaced rivals, and imposed harsh controls on production and trade. The same structure that allowed investors in Amsterdam to share profits allowed violence overseas to be organized at corporate scale. This is the darker side of the world's first IPO. The share certificate made risk divisible. The company charter made power transferable. Investors did not need to sail, fight, or govern to benefit from distant conquest. They could stay home while the corporation acted in their name. The VOC's early success was stunning. Dutch ships returned with spices, textiles, porcelain, tea, and other goods that fed Europe's appetite for Asian luxury. Amsterdam became a center of global commerce. Warehouses filled, shipyards boomed, financial markets matured. The Amsterdam Exchange became a place where shares, commodities, and information circulated with increasing sophistication. The VOC helped transform capitalism because it solved a basic problem: how to fund enormous ventures when the risks were too large for one person or family. Its answer was the joint stock company. Risk was spread, capital was pooled, ownership was divided. A company could outlive its founders. That was crucial. A family business could be powerful, but fragile. A death, a feud, or a failed voyage could break it. The VOC created something larger than any household. It used family power to launch itself, then turned that power into an institution. The dynasty did not disappear. It became embedded inside corporate governance. This is why the VOC feels modern. It had shareholders, directors, a charter, tradable equity, global operations, military capability, political lobbying, complex accounting, and a public market for ownership. In many ways, it was an ancestor of the multinational corporation. But it also reminds us that financial innovation is never neutral. The first IPO was not only about opportunity, it was about who had access, who held authority, who carried risk, and who paid the hidden costs. In the Netherlands, investors saw global trade. In Asia, communities often experienced the VOC as a foreign power demanding control. The Dutch dynasty that built the world's first IPO was not a single bloodline wearing a crown. It was a dynasty of capital. Families whose ships, marriages, offices, and ledgers created the conditions for a new kind of empire. They understood that the future would be won not only by armies or kings, but by organized investment. In 1602, they turned a dangerous voyage into a share.